Hi, and welcome to a Pepperstone video where we'll be explaining equity and margin within the Forex markets. To begin with, I'd like to take a look at a leverage example at 100 to 1 leverage. If we wanted to buy or sell one lot of Great British Pound US dollar, and let's say the price was currently at 1.46327, this would generally mean that we need 146,327 US dollars within our trading account to gain the exposure of one lot of Great British Pound US dollar at that price. Now that's a lot of money and not everyone has that available to them. So what we can do is use the power of leverage at 100 to 1 with Pepperstone to gain access to that particular contract size. We do this by borrowing 99% of the exposure and providing 1% of the exposure, or in this case, 1,463 US dollars in our trading account. This 1% represents the margin held to have this position open of one lot of Great British Pound US dollar. So let's now take a look at how this looks in a standard trading account with Pepperstone of $5,000. The margin held for this position would be $1,463. The free margin would be represented by the available money that isn't currently being held to have that position open. We figure this out by taking our initial equity, or $5,000, minus the margin held, or $1,463, and we get $3,537 of current free margin. It's important to note that at any point, if we want to work out our current equity in our account, we can take our free margin plus our margin held, and that will give us the amount that we would have if we closed our trading position at any point in time. So let's take a look now at what happens if our trading account goes $200 against us. So the margin held for having that position open still remains the same at $1,463. However, our free margin will change because our trade is currently $200 against us, and it will become $3,337. This would mean that if we closed our trade at this point in time, we would have a total equity of $4,800 remaining in our account. Let's now take a look at what happens if the position goes $500 against us. Again, our margin held will remain the same. Our free margin, however, will go down by $500 this time, and that would mean that if we close the trade at this point, we would have a total equity in our account of $4,500. Now, what happens if the position goes our entire free margin against us, or in this case, $3,537 against us? This will mean that our margin held would obviously remain the same, but our free margin will go to $0. And this would mean that our equity at this point, if we closed, would be $1,463. At this point, if our trade incurs further losses, a margin call event will soon be triggered. So now let's take a look at Pepperstone's most popular trading platform, the Pepperstone MetaTrader 4 platform. If the position goes into margin call in the MetaTrader 4 platform, we have what's called the 20% MT4 closeout level. You can see here on the right-hand side, we have our $5,000 US account as we enter one lot of Great British Pound US dollar like in the previous examples. You can see the green level represents our free margin and the red level represents our margin held. Now, like in the previous example, if our position goes $3,537 against us, we'll enter our margin held area. If this happens, a margin call event will soon be triggered if the trade goes further against us. So let's take a look at what the 20% MT4 closeout level means. Here we have our $1,463, which represents our margin held. You can see that if the trade goes a further $1,170.40 against us, it will enter what's called the MT4 closeout or liquidation level. This $1,170.40 represents 80% of $1,463. You can also see that the $292.60 represents 20% of the $1,463. It's important to note this liquidation level will trigger a sale at the next available price. So we may not always see $292.60 if the market is moving quickly. You can also see the calculations on the left-hand side to how this is worked out. Now, it's important at this stage to note that it's always your responsibility to monitor your account at all times. And whilst we always attempt to close you out at the 20% MT4 closeout level to avoid any negative balances, we always encourage traders to never reach these levels, and you can always try to avoid this by using stop losses with the aim of exiting at a specific level. Now let's take a look at another one of our popular trading platforms, the C-Trader platform. If the position goes into margin call on the C-Trader platform, we have what's called the 50% C-Trader closeout level. Again, on the right-hand side here, we have our $5,000 US trading account as we enter the market with one lot of Great British Pound US dollars. Now again, if our position goes against us $3,537, we'll enter the margin held area of our account. So let's take a look at how this looks in the C-Trader platform. Here on the right hand side we have the $1,463, which represents the margin held. You can also see that this time, if the position goes a further $731.50 against us into our margin held, this will trigger the C-Trader closeout or liquidation level within our account. This is calculated by taking 50% of the amount off the $1,463, and then we should be left with, at the next price, approximately $731.50 in this example. You can see the calculations to how this is worked out on the left-hand side here. So you can always expect to be closed out with a higher amount in your trading account with the C-Trader platforms. But again, we encourage that you always use stop losses, and this is the last resort for us to try to close your account before it hits a negative balance. So let's now take a look at what happens if the one lot of Great British Pound US dollar we traded goes $500 in our favor. At this point, our margin held will still remain the same. However, our free margin would go up to $4,037, and our equity would go to $5,500. So if we chose to exit and take profit at this point in time, we would have a new balance of $5,500. We hope this video helps you today, and we'll see you in the next video.